Welcome to the Fund Your Retirement podcast.
The insight that every wealthy person's ever had in their life is that a truly wealthy person, somebody can live on the income from their capital, not on the income from their labor, from their work. And the wonderful thing about the modern age is that everyone can do that. That's a big part of our message. It's just that in order to achieve that, you have to learn about financial markets, and nobody does. Everybody learns how to drive a car. Nobody learns what is a share. There's something like only about 8% of people in this country knowingly invest in equities and other similar financial assets. If you ask them a lot of people, you ask them if they have a pension, they don't even know the answer. Or if they do know the answer, they have no idea what it's invested in.
Today, I'm delighted to introduce Andrew Craig. Andrew is an ex-investment banker, founder of Plain English Finance, and author of Amazon bestsellers, How to Own the World and Live on Less and Invest the Rest. After working for many years in the finance industry, Andrew realized there was a significant disconnect between the wealth of an individual and the level of financial education they had. So he set up Plain English Finance in 2011 because of one simple truth. Understanding finance is the single most important factor for your financial success. Andrew believes the reason so many people struggle financially is very simply because they have never learned enough about money or the financial markets. So Andrew is here to talk about the financial markets, inflation, pensions, and getting started so you can build wealth and fund your retirement. Hello, Andrew. Thank you for joining us today. Really appreciate you coming on.
Well, thank you very much for having me. I appreciate being invited on.
Yeah, no, it's fantastic. We've been trying to schedule this for a few months now, but really glad that we managed to find the time because you're extremely busy at the moment. You've got quite a lot of projects going on, haven't you?
Indeed.
That we've just been discussing. So what I'd like the guests to primarily get started on is their journey, their experience, like a 30,000 foot view. So the audience, I'm sure many have probably heard of you because of how well your books have done, How to Own the World. But if you wouldn't mind sharing a little bit about your journey and story, that'd be fantastic.
Very happy to, although I've got to preemptively apologise to anybody in your audience who's seen me in other podcasts because I'm very repetitive. And I'll probably start changing my tune a bit, but because I always like to say that it's that classic question that British people are really bad at. It's like, tell us about yourself. And, certain other cultures and countries are very happy to tell you all about themselves. In great
intricate details as well sometimes.
But exactly. Us Brits are a bit more reserved. But I mean,
very much.
When somebody asks you the question, I suppose you have license to answer. But I guess I started, I did economics at uni, at Birmingham Uni in the mid-90s, economics and politics. I then, immediately after graduating from doing that, I was extremely lucky to get an internship in the US Congress in Washington, D.C., which was literally like the day after my last final exam. I found myself flying out there and thinking, what am I doing? All my mates are going to be spending the summer in the Greek islands or whatever, and I'm going to be in a suit in Washington. But basically went and did that for 3 or 4 months, then came back to the UK. And because I'd done that, all the places I applied to for jobs, which at the time was I didn't really know. I mean, we were talking earlier about not really knowing what you want to do with your life. I didn't know whether I wanted to be a civil servant, try and work in the Foreign Office or work for an accountancy firm, or I was pretty uninformed. But the great thing about doing an internship for a congressman in DC meant that everywhere I wanted to apply to was interested to have me in for interview, which was a nice place to be. And then I eventually took a job with what was then SBC Warburg, so Swiss Bank, which was a pretty great place to go, one of the world's leading investment banks. And then I've spent the last, it's nearly 23 years now, which is worrying, basically being what's called an equity salesperson, or to some extent a stockbroker. And so the job there is to call, and many of your audience will know this, but lots of people often don't, because investment banks are opaque and people don't really know what do all those people in towers in the city of London.
Yeah, it's like a black box type thing, isn't it? What actually goes on?
But broadly, my job is to call up people with large pots of money. I mean, that could literally be hundreds of millions or even billions in some cases, and suggest, basically argue that we think certain shares were a buy and certain shares were a sell. So the job of a stockbroker, and as part of doing that, we would float a lot of companies. So at Swiss Bank, we floated companies like EasyJet and LastMinute.com and Campari and Burberry, and it was all it was very exciting because I was in my sort of mid-20s flying around Europe because a lot of my clients were in places like Frankfurt and Paris and Stockholm, all of it. And so, but I think the key thing which led me to where I am today is that basically I did what are called smaller companies. So I wasn't doing Tesco or Shell or Glaxo or Astra. I was doing stuff that was probably less than about £2 or £3 billion market cap, which was a real learning curve, because the main point to make there is, therefore, I got to meet the CEOs and the chairman and the CFOs face to face, and I spent my life just meeting companies from every sector imaginable, which was a really incredibly fun and privileged place to be. Gave me a certain worldview. And then I suppose the final thing to say is that so I was actually living and working in New York for a bit in 2010. And I kind of woke up one day and thought, like, I'm not particularly enjoying the job. I'm not particularly enjoying this city. And I needed a change. And for ages, I basically had this real beam up on it about financial literacy. I mean, to the point about people not understanding what do people at investment banks or investment funds do all day. Even my really, my friends from uni who had other professional roles didn't really understand the nuts and bolts of finance, and for example, really didn't think about ISAs or pensions or whatever, even though they might have been doing really well professionally in another area. And actually, a lot of people who work in finance are pretty bad at that too. And so I took a bit of a career break and wrote what then became How to Own the World, which was originally 100,000 words on a website where it was like, click here to go to the next section. And
multiple different blogs and articles type.
And my cousin said to me, look, nobody wants to read like this volume of stuff on clicking on a web page. Why don't you make an ebook? And so we did. And actually my brother's best man is a guy called Tim Peacock, who's now the COO of my company. And he knew how to typeset it and graphic design it and get it up in lights on the Amazon CreateSpace platform, the self-publishing platform. And then before we knew it, like, we'd sold far more copies than we ever thought we would, and lots of people were writing reviews that weren't all, my family members.
Wasn't all, family and friends.
Wasn't all my mum. And the rest is history. I mean, that was 10 years ago, amazingly enough. We did. That was the first edition. We look at it now, and it's it's kind of embarrassing looking at it now, actually, compared to what it is now. But that was the first edition. We did a second edition in September 15. And we employed a lady who previously worked for Penguin to do it properly with like an index and an ISDN number and all that stuff. And then in 2018, I got a phone call sort of out of the blue. I actually got approached by Penguin and by Hodder and Stoughton, who are, happily the two biggest publishers in the world, amazingly enough, sort of saying, look, we've watched your self-publishing success with this book. Do you want to do it properly with a big publisher? And so we did. And that's the third edition, which you can see over my shoulder over there.
Brilliant.
And it's carried on just selling, and as you know, is usually one of the top kind of three, usually in the top 3 investment books on Amazon.co.uk, which is obviously lovely. And off the back of that, I've built a business called Plain English Finance, plainenglishfinance.com, which basically people who've read the book kept getting in touch and saying, look, really love your book, help kind of thing. And there are lots of rules around what you can and can't do with respect to that, but over the last few years we've just been on a journey to try and help. And the business exists to basically to improve financial literacy. That's the number one goal, to improve the financial affairs of as many people as possible. And we're still feeling our way ahead in terms of how we optimally do that as a relatively small company, but a growing company. And the final thing to say, and sorry for giving you such a long answer.
No, it's fantastic. It's good to know other people's journey and story. It really.
Well, yeah. I mean, because we're having a conversation earlier, there's always a fair bit to say. For anyone who's been 20 years after school, there's a lot that's gone on.
There's a lot gone on, isn't there? Usually in that period.
Yeah, exactly. But I've lost the thread of what the final thing I was going to say is now. But basically, so I always ran Plain English Finance and the book alongside a full-time job until last June, basically. So I'm coming up a year now where I've actually decided to just go full-time entrepreneur and do Plain English Finance and nothing else, which is sort of scary and exciting in equal measure. But so now I'm running Plain English Finance full time.
Could I? What's the overall plan then and vision then for Plain English Finance? Where do you want to see it? Because I know you've got for anyone that doesn't know, you've got the forum, haven't you, where people can join, and it's for, if it's almost for a cup of coffee a month, isn't it?
Yeah, so we have a subscription community, which is a $5 a month, which is currently hosted in Facebook, but in the relatively near future is going to be migrated onto a proprietary platform, like a members area of our website. And so that gives direct access to me and to the team, and there's a whole ton of content in there. And it's basically, people trying to navigate their way through working out what to do with their finances. It's important to stress it's a financial education, not a financial advice business.
Yeah, there's an important difference, isn't there?
Yeah, and I've written about it. I mean, so I've done the financial advisor exams, and we are regulated by the FCA. But to give financial advice, and I've written about this a lot, you have to sit down with somebody and have a really, do a great deal of work on understanding their attitude to risk, their debts, their mortgage, their income, their aspirations, their dreams, their plans for their kids, what they spend on holidays. That's it's called a KYC, or know your client exercise. That is a very time-consuming thing. And that actually means that, and this is part of the problem we're trying to solve, if you like, for people who don't have a ton of money, because that is a very resource-hungry, expensive business to do, because financial advisors, to give them their due, have to pay a lot to the FCA. They have to pay for indemnity insurance, their premises, traveling around the country seeing clients. And so, and they have to also price into their business model a lot of people not deciding to become their clients. They have to do a lot of on-spec meetings. And so actually, and especially in recent years, that's created a thing called the finance gap, which basically means that the only people that financial advisors, so if you actually want financial advice and somebody to say to you, you should do this, you should invest in this fund and do this with your money and have this allocation to equities or bonds or whatever, you have to have gone through that know your client process. You have to have real records. You have to write a formal investment report. And that means that it makes that's the provision of that service very expensive. So really, realistically, financial advisors can't work with anyone except for really pretty wealthy people. I mean, people who have really 6 figures or preferably 7 figures, which means that, but everyone needs financial advice. Financial literacy is demonstrably incredibly poor. And what we're trying to do is to be a financial education business and walk people through what we can walk people through, and then stop short of saying, and you should definitely invest in this thing, which is challenging because a lot of people get in touch. A lot of people read the book and get in touch going, which fund should I own? Or, my wife and I have got £100,000 in our pension. What should we do?
Should we do?
Yeah, and it's one of our biggest challenges is because some people don't like it when you say, look, I literally legally am not allowed to answer those questions. I can't give you financial advice. But the 2 other things we have done / are doing is, so a few years ago, working with 2 really high-profile professors, Andrew Clare and Stephen Thomas. So Andrew's on the board of Legal in General, and Stephen sets the CFA exams for the hedge fund industry, the fund management industry. So incredibly honoured to work with them. And working with them, we actually launched our own investment fund, called the Plain English Finance Global Multi-Asset Fund, which basically, my book's called How to Own the World, because it argues that if you own all assets in all geographies, that's basically a very sort of defensive way of looking at investment, because sometimes shares are up a lot and gold's down, and sometimes the reverse. And there's the evidence of a couple of centuries. Oxford and Cambridge and the Rothschild family and Harvard and Yale have all invested like this. And what we've done is we launched a fund 4.5 years ago to try and offer that very defensive product for people who are interested in that. But as we were talking about earlier, the next thing I want to do, I've just spent 7 years being a specialist biotech investment banker and learn an awful lot about the biotech sector. And as I said earlier, very excited about it. So we're hopefully going to launch a much riskier biotech fund. But a big part of our thesis is the most important thing that somebody should do when they're considering their finances and they don't have a financial advisor is think about the right allocation to aggressive things that could go up a lot and defensive things that will protect their money. So the return on your money and the return of your money, basically. And when you think about that, it's very important to think about your age. Because if you're 30 and you have lots of aggressive investments, whether that's crypto or shares, for example, if there's a 50% correction and you have, let's say, 10 grand because you're 30, you're now at 5 grand, which is annoying, but you've got many, many years to get, to work back up and benefit from the higher returns that you'll get from aggressive investments. And you've only lost 5 grand in absolute terms. But if you're 60 and you've got £1,000,000 in your pension, and you lose 50%, you lose 500 grand. It's a very different thing. So my second book, Live on Less, Invest the Rest, basically explained this idea of using 100 minus your age to cater to how you think about aggressive versus defensive assets to basically deal with that reality. So, God, sorry, that's another very long, rambly answer for you.
No, it's fantastic. Just to add on to that, I had a great conversation the other day with a guest as well, and he set up a pension for his son in 2003, and then, as we know, what happened in 2007, 2008. But it was set up on a direct debit.
Yeah.
So every month he was just buying the index, FTSE 100 it was.
Yeah.
So every month he was buying the index, and the stock market's ticking up. Well, of course, 2007, 2008 hit, and there was the big correction. But he was still buying the index as it came down. Every month. He was literally buying the index at the bottom, and then he got all that upside. And he said,
that's front and center. So our message is invest, don't trade. And crucially, invest. What you're doing here is from today for the rest of your life, right? That being to the point where you then have enough money to live on.
Yeah.
Because ultimately, all a pension is, in the old days when they actually worked and interest rates were at levels where they were, and we can perhaps come back to that, is, the insight that every wealthy person's ever had in their life is that a truly wealthy person, somebody can live on the income from their capital, not on the income from their labor, from their work. And the wonderful thing about the modern age is that everyone can do that. That's a big part of our message. It's just that in order to achieve that, you have to learn about financial markets, and nobody does. Everybody learns how to drive a car. Nobody learns what is a share. There's something like only about 8% of people in this country knowingly invest in equities and other similar financial assets. If you ask them a lot of people, you ask them if they have a pension, they don't even know the answer. Or if they do know the answer, they have no idea what it's invested in. And if you do learn these things, and if you do invest, exactly to your point, every month without fail over 20, 30, ideally 40 years, so maybe from 25 to 65, right? It's exactly that. When markets crash, you're buying in. Everybody's worried about a market crashing right now. But to your point, if the market halves, but you're buying every month.
You're buying every month.
Yeah,
when it goes back up, you get that exponential growth, and
the S&P 500, US equities have basically averaged about 9% per annum since 1872.
Yeah,
and one of the things so equities have averaged 9%. The average equity investor has averaged 5%. And that's a huge difference, particularly when you look at the mathematics of compounding. And that gives you a much smaller result when you're getting towards retirement than if you'd had the 9%. And the reason for that difference is that most people try to time the market. Most people are not philosophically or emotionally strong enough to go, like right now, I get all day, all week, every week is people,
what should I buy?
Well, but also, should I, is now the right time to invest because of Ukraine? And 2 years ago, it's because of Libya, or maybe a bit, but there's always or Trump or Brexit or whatever. And the biggest, what we try to drive home all the time is do not think like that. You just set up something sensible and invest every month without fail for as long as possible, and ignore the news. And so that's investing and not trading, because basically that is trading. And obviously the most extreme end trading is buying something this morning and selling it this afternoon. Trading's really hard. Trading takes a lot of time, and I don't have any problem with people trading. I mean, I've traded over the years when I've had more time than I do at the moment. But I would say to be a good trader and consistently win is probably a degree's worth of knowledge. So anybody tells you can learn it in a weekend by going, it's just not correct. And crucially, somebody who says that they can trade in 5 minutes a day, they might be able to do it because they've been practicing it for 10 years.
I was just going to say that, yeah.
But most people can't. If you've got 3 kids and pet a dog and or whatever, trading is, I think, a very bad way. And the other thing is to succeed with trading in a low enough risk way, you probably need, I would say, £100,000 or more, right? Because and this is one of the biggest rookie mistakes we see, is people in their 20s going straight. They're a white belt in judo or karate, and they go straight to trading crypto, which is the equivalent of fighting black belts, right? Before they've done, I don't know, what is it, brown belt, yellow belt? No, I've got the yellow, whatever. Before they've gone through. And the first belts to do in financial markets is to sort out your ISA and figure out your pension, and just get that saving and investing habit of X% a month of whatever you earn going into something for the rest of your life.
Well, the thing about trading as well is if you think of trading as almost, it's like a skill set, a profession type sort of thing. You know, you go to a bank, you spend many years learning it through, you go through a development, they've got their own training programs. Much the same as to become a lawyer or an accountant or a solicitor. It takes many, many years to get to from starting ground zero to become a qualified solicitor, a qualified accountant. It's the same with trading. As you quite rightly said, you can't just learn it in 2 days. It's many, many years of development.
And that goes back to my point about it being time consuming and needing quite a lot of money. If you're 29 and you do, I don't know, insert any job you're doing, you're on a career path and hopefully you like your job. I mean, a lot of people don't like their job, but let's say you're lucky enough to like your job. I'm such a big believer in the fact that your time is better spent getting better at your job and, building your knowledge and your skill set and your network in your job. The likelihood that you then become quite consequentially wealthy is far higher probabilistically by spending many hours doing that and then doing the investing piece as on autopilot thing that you just have going in the background, listening to hopefully people like us, and there are plenty of others like us with a similar message, but it doesn't have to necessarily be us. But that's a much better way of spending your spare time in your late 20s and your 30s than sitting on crypto channels all day, every day, spending untold hours working out whether to buy this altcoin or short that altcoin. For most people. And certainly, I think that will, obviously we've had this extraordinary explosion in crypto particularly, which is a bit like .com in 99, 2000. And we can get into whether or not that's going to be durable and continue. I think it's not a controversial thing to say that there will, of course, be lots of winners in crypto, just as there is Facebook, Netflix, Apple, Amazon, Microsoft, Google. But, if you were, I was at the coalface in .com, IPOing companies like lastminute.com in my 20s, and I had mates who were making, £10,000 a week from buying this and that, who were a bit older than me, had more capital. Again, to the point, they were 10 years older than me, had more capital than me, so they could do that. But then they ended up owning a bunch of things that fell 95%. You cannot know. So Nokia, Nokia was at one point worth about 80% of the Finnish stock market, and everybody was believing Nokia would be as big as Google and everything. And then Apple came and wiped the floor with them. And what's any crypto asset today, you see these people who are just unbelievably evangelical about, obviously Bitcoin and Ether, but lots of other altcoins, and they're so nailed on, just convinced that this will be the $1 trillion or the multi-billion dollar altcoin. There's no way of knowing that. And so I think spending untold hours of your time doing that on a risk-adjusted, probability-weighted basis of how to spend your life is not as good a thing to do as spending your life getting better at the thing that you want to, where you actually make your crust. That's just my genuine, and I think that position will become very clear in the next few years for a lot of people. I really do.
Well, just to add a little bit more to that, I've had some really great guests on the podcast recently, and I like to get people on who've achieved the retirement or financial independent, just really normal. They worked hard, they saved, they invested, and at 48, 49, 50, 51, they're financially independent and they've left their careers, and now they just want to share the knowledge that they've learned over those years of doing it. And that's a much, should we say, safer way to do it, and more achievable than.
Well, that's right. On the about page of our website, I used a couple of examples to exactly that point. One is that there's a book called The Millionaire Next Door, which is a really famous book in the States. It's been around for quite a few years. That basically says that statistically, the vast majority of American millionaires are people who've done exactly what you just said.
Yeah, it is primarily Americans, by the way, that I've been chatting to about it.
Well, and Americans tend to be far more. Americans care about the market than British people, just culturally, which is a shame because we invented the stock market, right? So, they took the ball and ran with it, and we are getting. But people in Britain are getting more interested. But sadly, as I said earlier, a lot of them are going straight to black belt, and they're bypassing fundamentals like shares. But the Millionaire Next Door makes that point, and it doesn't have to be by the time you're 75. If you start in your early 20s, you can do it, as you say, in your late 40s, let's say, and you can do it on a relatively normal income if you're just willing to use property, shares, etc., etc. Whereas only last week, Boris Becker was sent to prison, right?
Yeah.
And the list of celebrities, George Best, his son Callum Best, the apple didn't fall far from the tree. I'm trying to think of others, but and they're not really off the top of my head, but I've written about it. But there are dozens and dozens and dozens of celebrities who've had huge incomes that have ended up bankrupt. There are 150 ex-Premiership footballers in prison in the UK because they earned 30 grand a week as a Premiership footballer in their late 20s or whatever, and then they left and turned to crime to try and sustain that lifestyle. What a crying shame, because if any of them had just learned the basics of the stock market and financial market investment, they would have had a fabulous income forever from then on and not had to do that. And then the other classic is that, I can't remember, the American Society of something to do with financial markets, basically Endowment for Financial Literacy, I think it's called. But anyway, an outfit in the States that has shown that 70% of lottery winners in America are bankrupt within 3 years of winning the lottery.
Right. Yeah.
People are winning
10.
So money, the point being is that money is not necessarily about income. It's about knowledge. It's about habit. It's about, understanding some stuff. And to go back to I use this automotive analogy a lot because it does resonate with people, which is that, I said it earlier, everybody learns how to drive a car. The vast majority of people in modern Western democracies learn how to drive a car when they're 17 or whatever, or in Texas 15 or whatever it is, but lucky them. But and that takes how many tens of hours, or I don't know, have a rough guess how many hours it takes to learn how to drive a car safely and not crash. Tiny percentage of people learn and spend the same number of hours, and it is the same number of hours, to learn how to drive their finances. Like basically no one does it, which is, if you think about it, that's insane, because everybody just assumes, everyone then just says, oh, well, driving a car, from whatever background you're from, within reason, driving a car is seen as a normal life skill that everyone basically should have, and it's pretty unusual if you don't have it. But learning about money, no, that's for rich people, that's not for me. Yeah. And that's crazy, because learning about money doesn't actually take any more time than learning how to drive a car. And I think that's and hopefully in a small way we can change that. But I would argue that in the long run, particularly in an urban society with Uber and Zipcar and whatever else, arguably learning how to drive your finances is an even more important life skill than learning how to drive a car. And the other point to make is if you don't learn how to drive your finances and then you start doing financial things, you'll crash. In the same way that if you don't learn how to drive a car and you get in a car and go and drive on the road, you'll crash. Yeah. And far too many people are doing that at the moment as well.
Yeah, agreed. I've got a great analogy as well, that just to summarize all that, spend less, earn more, and invest. Kind of summarizes my second book's called Live on Less, Invest the Rest. There you go. Go and buy that book then. So yeah. So there is two main topics that I also wanted to cover with you that I think are really important that people also need to understand, because I think a lot of people are relying on the government to perhaps take care of them. And there's two big things that I think people need to understand as well, and that's inflation and the government pension systems, which we wrote about extensively in the How to Own the World, which is a great book, by the way. I've read it. I love it. It's brilliant. And
thank you.
Why I've reached out to you. I recommend everyone go and read that book if you haven't. So, if I read out a quote from one of the books here on pension systems, if that's all right. So I'm just going to read it out here for everyone who's watching. Pension systems all over the world are essentially bankrupt. This is a controversial statement, but completely factual nevertheless, with very few exceptions. Wherever you live today, you absolutely cannot count on being able to live on government handouts for the rest of your life when you stop working. Nearly every Western government is effectively bankrupt, and debt per capita in the US of 2015 was $44,000. Today, at 2022, it's $60,000.
Yeah.
I hope you enjoyed part one of this conversation with Andrew. Part two will be released in a few days, where we will take a deep dive into state pensions, government debt, money printing, and inflation. To be notified when part two comes out, please subscribe and turn on the notifications. Thank you very much for your time. I look forward to seeing you in part two. I hope you enjoyed the video, and if you haven't subscribed yet, go ahead and subscribe to our YouTube channel. And you don't have to stop there either. We have more videos on the screen for you and lots more insightful content on our channel and at our website fundyourretirement.com. I want to thank you very much for your time, and I'll see you in the next video. Bye for now.